Getting money, never losing hope. But I'm broke, but now I'm living adding digits, count my zeros and some decimals.
Hello.
Wish you would try to teach me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested dough when I let it grow. Regiments, I got a pocket full. Rich the income and your taxes low. Spend it right and then invest some more. And if you don't believe me, ask my doctor down. What you mean? You mean Uncle G? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the jet. I buy apartments, I send checks. Yo, billionaire went undercover, help y'all discover who did it best. Just bought 2 choppers, can't wait till they see the face and they see what I do next. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow.
Yeah, and only then do I buy something stupid. How stupid can you go? You can go as stupid as your cash flow.
You know what heals all ills? Deals. Look who went from meals to bills. It's eat what you kill when you're in the field. In the pipeline overflowing, I don't drip, I spill. We don't seek balance, nah, we want extraordinary. If you really knew my dreams, it'd be more than scary. We got more to spare, ain't no shortage, baby. Winning by the chopper and another for my lady. Talking about the bird in the strap, say the word and she handle that. Fully loaded, put it at the target, and you know we letting off every man. Got my money, who got my back? You can never get it if you never ask. Big bags, legendary swag. Only one thing better than cash. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. When I walk through, no I won't do, no I won't do, no I'm talking to, not to, you don't about to do, what? Walk in that door.
Right. Asana, a work management platform that helps companies get more done and save more time. Teams can stay connected while they track updates and visualize timelines. Asana, a smarter way to work. Try it for free today at asana.com.
Okay, I will find a better way of doing this. Can everybody say yes? Yes. Okay. Now I can't see the chat. I'm all messed up. Can everybody hear me? Put a 1 in the chat. Let me see if you're listening.
I can hear you.
1 person can hear me. Okay, 2. There we go. All right. Hello, everyone. Happy Wednesday. Welcome to our Multifamily Freedom Chasers Financing Zoom. My name is Shelly Miles. I am a commercial mortgage broker and the co-founder of our brokerage company called Adventure Commercial Capital. What we do is connect real estate investors to lenders. Jerry, you want to go ahead and take over?
I will. Thank you for the introduction. I am Jerry Miles. I'm the other half of the founding party, I guess. So we are the founders of Adventure Commercial Capital, and we're here every other Wednesday doing this Zoom call. We're here to educate real estate investors on the debt market and different products that are available to finance real estate. And just here to be a service to the real estate investing community. So glad everybody's here. Hope you're having a great evening. And I hope you get something out of the call tonight. So the topic for the night is what are the top 5 factors to consider when investing in real estate? Today's agenda, community ecosystem. We'll go through a little bit about the Multifamily Freedom Chasers community and what we're all about. We'll go through introductions on who we are, and then we'll give a couple of you a chance to introduce yourselves if you'd like. And we'll go into the current debt market update and then the main topic for the night. And at the end, we will have probably 10 minutes or so that we can do question and answer. So moving on to the community ecosystem here. The Multifamily Freedom Chasers community was started by the three gentlemen all the way on the left of your screen, Marcel, Victor, and Trevor. And Trevor is actually doing the calls now, alternating Mondays. He does what we call the activation Zoom, and usually has a celebrity guest of some kind on here. Alternating Mondays, we have BB and Iffy, and they do asset management and different challenges, that come with multifamily operations. And then alternating Wednesdays, you have me and my lovely wife there, alternating with Ed and Kevin, who are commercial real estate brokers. So they've got some great info as well. Me and my wife, Ed and Kevin, we are full time in the commercial real estate space. So we eat, sleep, and breathe it. So
Yeah, and those of you who are not part of the Facebook page, I just dropped the link in the chat, so you can join the Facebook page, so you can get all the event updates on here and links.
awesome. Who are the Miles? Then in the picture there, you see me and Shelly, my wife that's here on the call. JJ here is on the call. He is our older son. He's a senior this year. And then Jordan there, that's sitting in front of JJ in the picture, is an 8th grader this year. And but we are commercial mortgage brokers. We lend on commercial real estate nationwide, all different types of commercial real estate. We are real estate investors ourselves, have been for about the last 10 years. And we saw a need for some honesty and integrity in the lending space. We were treated unfairly, is how I would say it, by some lending brokers back quite a few years ago. And because of that, we decided to become the brokers ourselves. We connected with a lot of different sources of funding. We joined a national association of commercial lenders, which gave us access to a lot of different lending sources. And so we opened up shop 4 years ago, and have been going strong and looking to grow our lending company and our real estate portfolio both. So if anybody would like to introduce themselves, you can raise your digital hand or speak up, and take 30 seconds to a minute. Tell us who you are, where you're from, what kind of things you're looking for, what kind of real estate experience you have maybe, and then just get your name out there. There's been people on this call that have done business together because they met each other on these calls, and I think that's awesome that they've been able to meet on our call, connect, and then go on to do business together, and it's been beneficial. So if you'd like to go ahead and raise your digital hand, or just go ahead and speak up. JJ Miles, go ahead, man.
Howdy. Yeah, my name is JJ. These are my two parents running the call. I come on here and I help them because, I'm here and might as well. And I do YouTube. I'm a YouTuber. That's what I do as my job now because I'm making a pretty decent amount of money now because I've had a few videos do well. But yeah, that's pretty much me. I'm a senior in high school. That's pretty much it.
Awesome. Thanks, JJ. And JJ's also doesn't like me mentioning this, but he is this year's valedictorian at his high school. So he likes to claim his YouTube as better than that, which, I can't disagree, but he is a valedictorian of his class this year, so we're proud of him there. So if I see Jacob has his hand raised. Go ahead, Jacob.
Thank you. Yes, my name is Jacob Havlovic. I do apologize for not having my camera on. I'm at the gym, and this is the only time I'm available to get on the call.
Yeah.
But the reason why I joined this community and to get back in the real estate game is went through the traditional route, going to school, went to college, graduated, and then went to work, but realized it was not as fulfilling as I'd want, wasn't properly utilized. And so tried to pursue real estate investing on my own. Found that was very difficult to do by myself. Learned a lot of lessons, sought out a mentor, and then actually went back to school to learn how to properly underwrite because either my mentor was holding out or he didn't know how to underwrite. And so now I'm trying to get back into the game. And that's where I am, essentially starting from ground zero, but have a breadth of knowledge, if you will.
Awesome. Awesome. Well, good to have you here. What part of the country are you located in, Jacob?
I am in Phoenix, Arizona,
Okay.
and my background is a mixture of safety and health in construction, but also financial analysis, accounting, FP&A. That's my unique mix there.
Yeah, I'd say so. Well, cool. Good to have you here on the call.
Good to have you, Jacob.
All right. Anybody else going once? All right. Kalina, I think I'm saying it. Hopefully I'm saying it properly. Kalina? Good.
Hello,
Yeah.
can you hear me?
Yes, ma'am.
Yes, you're pronouncing my name correctly. Unlike many people not pronounce it correctly, but you did. Thank you.
Good.
Appreciate it. I wanted to introduce myself. I'm sorry I'm not on camera because I'm driving right now.
Yeah.
Didn't want to miss your call and wanted to kind of take a few minutes to introduce myself. I'm an attorney. However, I do have a strong background in commercial real estate. I worked as a general counsel for a large developer of shopping centers and big commercial projects in the state of Florida, and participated in every aspect of the development, from site acquisition, construction, financing, getting loan documents reviewed, and finalizing different type of loans to commercial leases and potentially disposition of the property by the projects by sale. Also established a title company, and we did closings. I was agent for Chicago Title and Fidelity Insurance, and closed a lot of multi-million-dollar transactions.
Awesome.
Wow, that's awesome.
Very, very
Thank
cool.
you.
And you guys are in the right spot to meet people like this. Go ahead and throw your information in the chat so everybody can connect with each and every one of you. And that's for everybody. Everybody throw your information in the chat. Throw
Yes,
your
thank you.
markets in the chat. Oh, yeah. Thank you. It's awesome.
It's great to have you here, Kalina.
So
Nice
part
to
of-
meet you too, guys.
Yeah, good to meet you.
Part of why we do this Zoom, guys, is for you guys to connect with each other and meet like-minded people
Oh, yeah.
and build your team.
That's right. That's right. All right. Well, I'm going to go ahead and move on to the current debt market update. the numbers are a little down. I'm guessing the weather's nicer everywhere because getting springtime weather. I think we were at 40 something last week and we're at 13 this today. So um I'm guessing maybe springtime has something to do with it. I don't know. But the current debt market, um, where are the current rates? The Federal Reserve's rate, 5.25 to 5.5, the highest federal funds rate in 22 years. The 10-year Treasury, I look at these treasuries to determine rates. Like if we're looking at long-term rates through CMBS or through Freddie and Fannie, those are all based on the treasuries. So if you want to know kind of what your rates are going to be on a stabilized multifamily, I'm assuming this stabilized property is going to qualify for Freddie or Fannie. You can look at the 10-year or the 5-year treasury if you want a 5-year term or a 10-year term. You can take the treasury rate, which today the current rate, 10-year rate is 4.227. You can take that if you have a small balance loan, which would be under 6.5, 7 million range. If you're under that range with your loan amount, you're going to be in the small balance space. You can add 2 to 3 points on top of that. So anywhere from 6.2 to 7.2 on the 10-year, or the 5-year as well right now. If you've got a larger project where your loan amount is going to be above that 6.5 for or 6 for Fannie, 7.5 for Freddie, you add 1.5 to 2.5 on the conventional side. So nicer assets, are going to get you better rates and nicer locations. Borrowers that have a better track record or more of a track record are going to get better on the better side of those rates. You get better rates if you have an affordable housing component to the deal. So those are the things that will determine the rates. If you're kind of out in the middle of nowhere, maybe employment is an issue in the area, those types of things. If we can get it funded, you're going to be on the higher end of those rates, or maybe even more in some cases. So just things to keep in mind when you're looking to find out what the treasury rates are. I'll pull it up here. Hopefully I don't mess the screens all up by doing this, but I'm going to do it anyway. You can go to cnbc.com. You got your 5-year treasury. Can everybody see that? Is that mine on the right screen there? But you just go, you can type in a Google search 5-year treasury or 10-year treasury. CNBC is the first one that pops up, and you can see what your treasury is here. You say, okay, I'm looking at this property. I'm at 4.2. You can look at your loan amount. If you're above that 6.5, 7.5 range, you're going to be, 1.5, so 5 and 5.7 to 6.5 range above that, or 5.7 to 6 3/4 to 7 range, or whatever. So that's why the treasuries are important. If you're borrowing money from a different source, the banks will all have their own ways of determining their rates, and a lot of it depends on who they're borrowing money from to lend you the money, or how, where the money's coming from. Sometimes they'll go off of the Fed rate, sometimes off of the Bank of America rate, which is I think 8.2 or 8.4 or something today. You'll have the SOFR rate, which is a popular rate that people borrow against. A lot of the lending institutions borrow against. So a lot of different things. So you'll hear a lender sometimes will say, we're the 1 month SOFR plus 5. So a bridge lender might be like, that that SOFR today, I think, is 5.2 or 5.3. And they're going to be at that, 5 over that, so 10.25. So not to take too much time on it, but just try to explain it a little bit. If you want to take a picture of this, Freddie Mac small balance right now, these are the rates that you can get. Freddie Mac is the small balance is 2 million to 7.5 million, 5+ units. We can do loans 1 to 2 million range, but they're going to be a little higher as far as your rates go. This here is the Fannie Mae. You got your 5-year fixed, 7-year fixed, 10-year fixed, 80%, 1.25, and then you see all the way on the right, 55%, 1.45. You see that the rates are lower because your loan to value is lower, or your loan to value is lower, and then your DSCR is higher. So that makes the loan a little more, enticing to the banks. So, over the last, I guess it's been a year and a half, we've been kind of in a stagnant market since the rates have jumped up. I was just, I heard back, I guess 6 months ago, that half of all lenders, whether residential or commercial, are going to drop out of the market over the next year. I heard that. I've talked about it on here just because the workflow is so low right now. And then I clicked on, I don't get on LinkedIn a whole lot, but I got on LinkedIn and I saw, I don't know, how many did I show you? Like 3 or 4, like the 3 or 4 posts, the first post that I saw on LinkedIn, I was showing my wife there. I said, hey, look at these. Remember me talking about all the lenders that are going to be dropping out of the market and things? Well, these first 3 posts on here are guys that I know that are lenders, and these guys have all dropped out. They've gotten work elsewhere in sales positions at other companies and doing totally different things than lending now, just because the workflow is so low. That's going to continue to happen. We have probably at our access, a year and a half ago, 25 or so bridge lenders and private money lenders, that have their own funds and that they lend money for different types of real estate that we have contact with, that we can do business with. I would say probably, this is just round numbers, half of them have dropped out of the market because either they're into loans right now that the borrowers can't get out of, and they don't have that turnover of money, and they're just collecting the payments. They've gotten rid of their help in the office. They've gotten all these things. And I talked to a guy that was running a $500 million real estate fund, where he's a debt fund. He just lends it out to people for short-term projects. And he was telling me that they shut their fund down. They returned all the money that they have right now. They returned it back to the investors. And he said that we're expecting to open shop back up in 2026. So these are just a sign of what's going on in the marketplace. So, I mean, those aren't good things, but because of the bad things that are happening, there's going to be a lot of opportunity coming to the market. There's just not been things buying and selling. So a lot of these people are not making enough money to stay in the market. But sellers are going to be forced to sell as time continues on. Interest rates stay higher for longer. They're going to be forced to sell. They're going to run out of money to continue paying more on these properties than what they're collecting. They're not going to be able to hold on forever. And there's a major correction underway. Properties are not worth today commercial properties are not worth today what they were a year and a half ago. In some cases, the valuations have cut in half. In most cases, they've cut, 25 or 30% off the value. And we're talking to people every day that are in properties right now, and they're in trouble. They might have a $8 million or a $10 million bridge loan that they bought a property for 12 or 15 million 2 years ago. Now they need to get out of that bridge loan, and where they plan to get out of that bridge loan with a 3.5% or 4% interest rate. Well, that interest rate now is a 6 to 7%, and now they can't borrow what they owe on, and so they're being forced to sell. Unless they bring a couple million to the table, a cash in, refinance, they're not going to be able to refinance and hold on to these properties. So $2.7 trillion of debt maturing by 2027. 540 billion is maturing by 2024. In 2024, 450 billion in 2025. And we're seeing more and more where lenders are just starting to list properties. We've known a few people that have lost properties back to the bank. They go into what's called a technical default. A few of them have, and the technical default is they're not meeting the DSCR requirements that the lender's requiring them to maintain to be able to continue with that loan. So these are the things that are going on in the market, but because of this, there's going to be some, you could say a huge transfer of wealth, because people are going to be able to buy these properties cheaper. And then as the market comes back, over the next few years, whenever it is, it might be 5 years, might be a couple years, it could be 10 years. But eventually inflation's going to kick back up, which raises the values of real estate. All these things are going to happen again, just like they have in the past. And so if you're able to buy in this market, you're going to do well in the next upturn. So that's my opinion. That's my 2 cents on it. So let's go ahead and get into the current, our main topic. The top 5 factors to consider when investing in real estate. And these are just 5. There's more. But these are just, I guess, probably the 5 most important. Number 1, I would say, is more important than any other, and that is location. Location, location, location. The most important thing. You can't change it later. Higher populations close to metro areas. Higher populations close to metro areas, and everybody knows what the good metro areas are. Even with the craziness in some of the metro areas, they're still the best places to own real estate. You've got people that will pay, more for rent. You've got, lots of job opportunities for your tenants, and just, the list goes on and on. I'm in Grant Cardone's Real Estate Club. I'm sure there's a few of you guys on here that are as well. Something that Grant always talks about is high barriers of entry. So he talks about, the California cities. He doesn't buy in California, but, high barriers of entry in California are, on the west side of every city in California, or the big cities. You've got the Pacific Ocean, so they can't expand that way. And then usually on the eastern side of all these cities, you've got mountains, and going into the mountains, you can't expand that way. So there isn't a lot of area to expand in those areas, which creates the land that's available to build on. It makes the values go up, and the prices are high, and so that is high barriers of entry. If you own there, the prices are going to continue going up. Miami, Florida, high barriers of entry. It's expensive to buy there. You've got ocean on one side, you got the Everglades on the other, and there's just not a lot of space there. So, the land that's there is going to continue going up because more and more people want to be there. It has positive migration. There's many jobs. A lot of companies are moving to that area. Low crime rates are important. I know it's kind of weird to say low crime rates when we're talking about metro areas, but the nicer areas of metro areas are still going to have some crime, but we have some areas that or have a lot of crime and are just you can't get out of your car or drive through with your doors unlocked. So that's what we're talking about out there. So, but location, you cannot change it. It's always going to be that location. So number two thing the second thing I would say to consider when you're looking at a property, especially in today's marketplace, and you're looking at this property, you're serious, it's got a good location, you like the look of it, you like all the things, find out why they are selling this property. If this person is not in trouble in this market, the valuations have gone down 20, 25, 30%. Why in the world would they be selling right now? If they're not in trouble, why are they selling? So when you're talking to a broker, you need to find an answer out to this question, and you'll get a lot of the basic answers of, oh, well, this was part of their plan, was to hold it for 5 years and then sell it, or, oh, they're merchant builders, they just build to sell. Well, if in 2 or 3 years you can get another 25, 30, maybe 40% on the sales price, why are you going to sell now? This is not a seller's market. And so the reasons why they're going to be selling that are good reasons for you as a buyer is, maybe their loan's maturing. They're going to go from their 2.9 or 3.9 interest rate, and they're going to go into a maybe a 6.5 or 7% interest rate, and their cash flow is going to be upside down. Did they do well and now they're just trying to cash out in this marketplace? I guess there's a chance of that if they bought 10 years ago. But even then, they're not going to be market sellers. They're going to be people that are going to hold off to wait to get their price that they want. Are they having problems? And what are the problems? Are you going to inherit those problems when you buy the property? That's an important thing to find out. Are they having trouble with the tenant base because maybe there's crime in the area and they're just really struggling dealing with it, or maybe there's a lot of poverty in the area and there's truly no place for these people to have a decent job to be able to pay rent. Is there some really bad plumbing or electrical or structural issues on the buildings that they're trying to hide from you? These are things that you need to worry about and to think about. And then just because you find these problems doesn't mean it's not a deal. The question you have to ask is, are these problems something that we can fix? So number one, location. Number two, thing to consider is, why are they selling? Number three, the asset quality. There's a lot of people that don't buy properties that are older than the 90s or older than the 2000s. So age might be an issue. Certain different types of properties that were built in different eras. You might have a plumbing issue, or they might have different things that you don't want to deal with. What's the condition of the asset? The tenant base. Who are the tenants? Where do they work? Are these young professionals, or these older, retired people? Are they, blue collared, white collar workers? These are all things that you need to find out. Is the tenant base, is it Hispanic people? Is it white people? Is it black people? You know, and none of these things are deal killers, but um, you know, maybe an old white guy doesn't manage a property or buy a property that is all African American tenants. You know, he's not going to relate to them. You know, or maybe vice versa. They might not relate to each other or get along. Um, you know, and just things to consider when you're looking at properties. Um, you know, what type of asset is it? A, B, C class, or you know, some of the neighborhoods I see, I'm like, I'm not even going to call that C. I'm going to call that a D. You know, uh, but uh, but asset quality is another big thing to consider. You know, the older the property, the more maintenance. You know, those types of things. So here where we're at, we're in the northern Kentucky, greater Cincinnati area. We have a lot of old properties here. You know, downtown, I mean, there's a lot of properties that were built in the mid 1800s. You know, and we've, you know, with our construction business, we've done a lot of major work on these properties, and unless they've been gone through and everything been changed, you know, I would say I wouldn't want to buy an old building like that unless they've got new electric and new plumbing and even new structures, you know, as far as, you know, supporting walls and all that kind of stuff. But just another thing to consider. So you've got location. Why are they selling? Asset quality. And next, timing. Um, you know, a lot of people are sitting on the sidelines right now. You know, there's people with money sitting on the sidelines right now because they just don't know what's going to happen in the future here. I mean, they're waiting, thinking, oh well, we're not at the bottom yet. Things are going to get worse, you know. And then there's other ones that are trying to buy like crazy because they see, oh well, this is the bottom. You know, it's just nobody knows. Nobody knows. Grant Cardone, something he's been saying. You know, we're on a call with him once a week through the real estate club. Um, he says, don't wait to buy real estate. Buy real estate and wait. So if you buy a property now, um, you know, we're going to have, you know, even if we go into a downturn, even more than what we are right now in commercial real estate, you buy a property now, you buy it cash flowing, and it continues to cash flow. In 10 years, chances are you're going to make money on that property. So the longer you wait, the more money you're going to make. So the rates go up, prices come down, rates go down, prices go up. You know, decade by decade, rents have gone up every decade since World War II. So think about that. The price of houses have gone up. You know, I've told this story on these calls several times now, but my grandmother and grandfather, my grandfather was stationed in California when they were young, and they bought a brand new house that was less than a mile from the Pacific Ocean in Monterey, California, for $8,000 in the 1950s. And that same house, 3 bedroom, 1 bath, is over $1 million now, I would say. You know, so $8,000. And how many real estate cycles have we gone down since then? I mean, just over and over, it's gone down and it comes up. It's gone down and it goes up even more. It comes down, it goes back up even higher. It goes down, it comes back up even higher than the last time. So, you know, if you could go back to 1950 and, you know, how many of those $8,000 houses would you have bought? Brand new construction in Monterey, California. I mean, if I could afford it, I would, and I was alive back then, and knowing what I know now, I'd have bought a bunch of them, you know. But anyway, so timing, yeah, people try to time the market. I think it's smarter. You buy cash flow in real estate, it doesn't matter when you buy it. You know, you buy it and wait, you let it cash flow while you have it. So. And number 5, risk. So there's always risk when you're investing in anything. I personally think investing in real estate is one of the least risky investments that you can make. If you have a good operator and you have someone with your interest in mind as an investor, or if you are the GP that's running the deal, I think it's the best thing that you can do as far as investing. You always hear people, oh, run your numbers with 3% rent increase per year, 2% expense increase. On our real estate club calls, this morning we had a real estate club call, Grant Cardone's Real Estate Club. 3 different people brought deals to the call. And I can't remember where the one deal was that the guy was talking, that Grant was talking to him about. It might have been Tampa. And the question that he had for the guy buying a deal, he said, okay, imagine this. Imagine you buy this deal, and in 10 years' time, we have 0 rent increases, because that's what this guy just kept talking about is, oh, I can raise the rents. I can raise the rents. I can raise the rents. And Grant said, imagine buying this deal, and in 10 years' time, you can't raise the rent one time. Would you still want to own this property? And he said, if the answer to that question is yes, then you should buy the property. How much do you like the asset? How much, so run the numbers as worst case scenario. Run the numbers 5 to 10 years with no rent increases. Would you still want the property? And those are just things, when you're looking at it. And another thing, if you're planning the GP a deal, if you are buying the property, your mom and dad are investing with you, and they're investing, they pulled their 401k out and they're putting it into your real estate deal. Run the numbers 10 years with no rent increases. Are they still going to make some money on this deal? Are they going to make money? Or are you going to be happy with the investment that you put your mom and dad's money into? Those are the things to look at when you're talking about risk on a deal. So location, why are they selling? Asset quality, timing, and risk. So we will open it up now for question and answer. If anybody has any questions, go ahead and fire away in the chat or raise your hand. Look at the chat here and see. And I'm going to go ahead and move on through the slides. We got several slides here to still go through. And if you have a question as we're going, just go ahead and raise your hand and I'll call on you. So needed for a quote. If you are needing a quote on a deal, on a debt, on the debt side of on the deal, we would love to help you. That's what we do. We would need a T12, rent roll, OM if they have it. Summary of what you plan to do with the property. What are you planning to offer? Is there CapEx that needs to be figured in there? Just let us know what your thinking is on a deal. As we get closer, if we're going to be signing an LOI with the lender, we're going to need SREO and PFS, which is Scheduled Real Estate Owned Personal Financial Statement. I don't know if everyone knows it's on here, so I'll go ahead and say it. If you are buying a multifamily deal or any commercial real estate, you need someone to sign on the debt with you. If you're not qualified yourself, you need someone to sign on the debt. To qualify, you need to have some track record of managing property or owning property. And generally it needs to be in that same asset class. So you're going to need somebody, if you're buying a hotel, that's run hotels. If you're somebody that has managed multifamily, if you're buying multifamily, and you need a net worth equal to or greater than the loan amount that you're trying to acquire. So just quick little things. You can qualify as a group if you have 3 or 4 partners, you're trying to buy a $4 million deal and you can combine your net worths. That will also work. We can combine net worths to buy a deal as well. So this is for someone that is.
A quick question on that. So does it count the primary residence?
Yes. Yeah, it counts your primary residence.
It can be.
Yeah, as part of your net worth, yes.
Okay, thank you.
Yep. So if you're a brand new in real estate, or maybe you're not brand new and you're still working, I'd say most people on this call, if you're on this call, you want to eventually be the person that people bring a deal to, and you come and you sign on the debt and you say, hey, yeah, I'll be a partner with you. I like this deal. I want to be able to sign on the debt on deals. So things you need to start doing today, make sure your credit's in order. They are going to look at your credit score no matter the size of the real estate deal. They're going to look at your credit score. I know a lot of the gurus say, oh, well, we buy with no credit. That's because they're finding someone to sign on the debt for them. Start working on your PFS and SREO. If you own some houses, start putting them down. If you've bought and sold some houses, start putting them down on your SREO. These bought, sold, work on your PFS, start writing down your assets against your liabilities, and start working, trying to add more to your assets and take away from your liabilities. Start getting your bio together. Work on raising capital or making more money. Another way of making more money is we have a referral program. If you bring deals to us, we will pay you part of our commission for bringing business to us. We'll be doing in the next couple weeks, we'll be doing a referral program call, and we'll be explaining how all that works and the amounts of money you can make.
Hey,
So,
yeah, and I want to give a quick tip on how you can boost your credit score a little bit. If you go to the 3 major credit bureaus and look on there to see all of your information to see if it's correct, 100% of the time, it's not all of your information in there. There's going to be something on there. So you can dispute those and say, hey, this is not me. You can also eliminate as many addresses as you can, like past addresses, and just try to keep at least one address on there, which is your current address, and one name, which is your current name. Like me, I try to get rid of like my maiden name and stuff like that. The less they have to search for you, the better your credit score is. And like my name was written so many different ways on mine, like Shelly Ann Dale, Shelly Ann Miles, Shelly A. Dale, Shelly A. Miles. And so I disputed a lot of those and tried to keep whatever they would let me get rid of, I got rid of, and whatever they let me keep, I just have to keep on there. But that helps and boosts your credit score like about 50 points. So try to do that. Just go create an account and keep up with it like every year, once a year, look in there. There's always something on there that goes on there that doesn't belong to you. And that's 100% of the time. There's something on there that does not belong to you. So
yep.
that's it.
Oh, yeah. Good tips. And the reason she's saying to eliminate addresses and names is 1/3 of your credit score is just verifying who you are. So if they have one name to go by and they have one address, it's real easy to verify who you are, and that will boost your score really quickly just by doing that. So just a quick little tip. So thanks for that, Shelly. So this week's verse, we do a Bible verse every week. This one is Malachi 3:10. We are givers in our church, and we believe in giving, and we believe in a giver's gain. So this verse is, bring the whole tithe into the storehouse, that there may be food in my house. Test me in this, says the Lord Almighty, and see if I will not throw open the floodgates of heaven and pour out so much blessing that there will not be room enough to store it. So we live by that, and you know, and we believe in a giver's gain. So our next,
Also, before everybody starts leaving, I forgot to tell everybody, last week was JJ's birthday. I don't know if he's still on here.
yeah, he's there.
He turned 18. Oh, he turned 18. Yes, I know I don't look like I have an 18-year-old son, but I do. So you can wish him happy birthday. It's a big milestone.
Yeah.
Turning 18. He's Go ahead, Ishwana.
All right.
Somebody there?
Yeah. No, I think they just said happy birthday.
Oh, okay.
So next Zoom topic, we will not be doing one next Wednesday. That will be Ed and Kevin. But the 3rd of April, we will be doing a call, and we'll be talking about navigating an economic downturn in real estate. So join us and see what we can come up with there. Here is different ways that you can plug into the Multifamily Freedom Chasers ecosystem: Facebook, YouTube, Spotify, Instagram, WhatsApp. So,
Yeah, and you guys can get all of our past Zoom calls on there as well, and all of the other Freedom Chasers Zoom calls there as well. So
Yep.
It's good.
Yeah. And the WhatsApp group, you can take a scan of that link right there, and that will get you into the Freedom Chasers WhatsApp group. I don't know how many people are in there now, but there's a bunch of them now, I'd say. So. And this here is our contact info. So that is my cell phone number. I try to answer it whenever it rings. And that is my and Shelly's email. And then you can scan the QR code there, and that is my hi hello card. So we'd love to connect
And
with
also,
you.
I don't know if you guys knew that we have a Fast Pass program as well. That's actually a paid program. We just finished our first 6 weeks of that. Jerry, if you want to speak on that a little bit.
Yeah, it was a 6-week Fast Pass to get you thrown into the space, and just a boost. It was an extra call every week, mentoring sessions, really small group. We limited it to 12. And so I believe everybody that was on there was really glad that they signed up, and definitely got their value out of that Fast Pass program. So it was a real big success, and we'll be doing another one probably towards the end of the summer. So don't miss out on it. There was people that tried to sign up after we filled up with the 12, and they couldn't. This isn't like a lot of the groups where you've got a guy that's just selling thousands of these things and bringing the people through like cattle. We did it because we felt like we could really add some value, and it also helps. All these calls and all the service that we're providing here through the Freedom Chasers community all costs money. So, the Zoom costs money, the CRM, just, sending out the reminders, all these things cost money. And, the leadership of the here, Trevor and them, they've been paying for it out of their pockets, and Caleb. And so this was a way to help to give some extra added value, and then also to help with some of the expenses. So I appreciate the people that signed up. And I believe that they all, if any of y'all are on here now and want to vouch for it being a good program, go ahead and do that.
And it wasn't even expensive, so it's not $1 or anything like the others.
So, Jerry, Jerry, could you speak about the agenda and the topic of that meeting? It will be helpful for everyone. We can, like a high-level agenda, what it covers.
Yeah, it was this time around, I believe it was just under $300 for 6 weeks of mentorship. And like I said,
I think it was $300.
what?
It was $300, but it was a discount for signing up the first day, and I think we got all 12 spots filled the first day.
Yep.
On the
I wasn't asking the fee. I was more of a like, what covers.
Yeah, you're really cutting out on us. I can't. I'm hearing every third or fourth word.
maybe he's asking what it all entails.
Can you hear me?
Yes.
Yeah, I can hear you a little bit better. Yeah.
Yeah, I was asking like, what covers in the multifamily segment? Is it underwriting or what exactly cover in the course? I'm not asking the price, so just what covers.
Oh, okay. Yeah, there was I can't remember every different week what we went over, but it was underwriting, it was building confidence when talking to brokers, how to talk to lending brokers, what to expect, what have ready, how to build relationships with key principals that can sign on the debt, how to raise money, it was just a quick education on all the aspects of purchase and real estate. So. Yep. So
Just more in
plug-
depth.
Yeah. So plug into the community. I believe next Monday is Iffy and BB, I believe, or is it? No,
I'm
it'll
not
be
sure.
Trevor.
I think they did this one. Yeah, Trevor
Yeah.
is going to be with a celebrity guest.
Yep, Trevor will have a guest. I'm not sure who it is. I probably should know, but I don't. And then next Wednesday we'll have Ed and Kevin. They just closed 120 something units in Destin, Florida. So they're going to be fired up and ready to tell us about it on that call. So jump on and learn what they got going. I know they're also under contract on a hotel out close to Yellowstone Park. So they got a lot going on. Get on there and check them out. All right. But
Yeah, and I just dropped the link again. In the chat. If you guys want to click on that and join the Facebook group, that would be great.
Cool. But I appreciate everybody being on here, and go ahead and give us some music.
Thank you guys for joining. Have a great night. Have a great rest of the week.
Yeah.
I'm going to.
Thank you,
Listen.
Shelly. Thank you, Jerry.
Yeah.
Happy birthday again, JJ.
Thanks for all the birthday wishes, guys.
Thank you. Again, happy birthday. Bye.
Bye.
See y'all.
I'll play some music.
When I walk through the door, I'm talking cash flow. And if you know like I know, you getting cash flow. Prove what? Getting money, never losing no. But I'm broke, but now I'm living at it. Digits, comma zeros, and some decimals. And I wish you would try to test me, yo. You should listen to the lesson, no. Masterminds out of Mexico, I invested though when I let it grow. Benjamins, I got a pocket full. Rich income and your taxes low. Spend it right and then invest some more. And if you don't believe me, it's my doctor down. What you mean? You mean Uncle Cheese? Planting seeds for these money trees. Who got my money, please? Everywhere you wanna be like Visa, MasterCard, American Express. I bought the bank and I bought the checks. I buy apartments, I send checks. Your